Lecture 4, Budget and Finance. A budget is a roadmap to financial success or failure. Budget is really the key to setting up a business plan. And all sports facilities require financial planning. So that's also a big thing to remember. What is an operating budget? And basically running the business, you need an operating budget. And there are things on there which would include your overhead, which are your staff salaries, electric, water, mortgage, rent, building expenses, including office furniture and maintenance, amongst many, many, many other items. Those are just a few that will get you started in the thinking process of budget and finance. When we talk about building a new facility and financing a new facility, there are a lot of different ways to finance a facility. Every sport venue has a different way to look at it, and a lot of different investors, a lot of different people who are looking at putting money towards a project like this. So private financing is an option. Collateral financing, putting equity in it from major corporations or invested people. Private investors, venture capitalists who would put percentage of money in, wanting a percentage of money back out. There are bonds, partnerships, partnership groups. When we talk about the Los Angeles Dodgers here, a major sale occurred relatively short time ago with an investment group headed by Magic Johnson. But there were a few people on his investment group who put in to acquire the Los Angeles Dodgers. So that's an example of a partnership group coming in. Public offerings, being able to sell stock in your company if you're going to own not just the facility, but a lot of vested interest amongst the facility, the team. There are a lot of options there. Some organizations or companies would offer stock offerings. An example of that, which we don't see too much anymore, the Los Angeles Lakers were owned by Dr. Jerry Buss. In the early 80s, they were the championship team, but he owned them in the 70s. And at the time, he was the only NBA owner who owned the team, the building, which was the Los Angeles Forum, the Great Western Forum, and the land that it sat on. Rarely does that happen these days. Few occasions you'll see it, but most often you don't see an owner that owns everything, the team, the building, and the land. And there you have much more equity to offer to people if you're interested in selling off stocks in your company. And then public financing, financing from the government perspective. And you'll see an example of that at AT&T Stadium where the Dallas Cowboys play. That stadium opened in 2009. Construction began in 2005, so it was a 4-year plan. It's a $1.3 billion build, and the city owns that stadium, the city of Arlington. They had a tax increase to the city to fund $325 million of the project, and in addition, the city sold $297.9 million in bonds to also offset the cost of the build, amongst other ways of receiving financing. But the city government taxed their citizens to be able to purchase and to build the stadium. So AT&T Stadium is a good example of public financing and how that works. Here's an example of how a budget is set up. Revenue and expenses. So when we look at revenue, it's really simple analysis. That's income. That's money coming in is your revenue. An expense is money going out, things you have to pay for. So as you decipher that and you're looking through the items here, these are just examples. Every budget is set up a little bit different, but these are key pieces you'll see in a stadium or venue, a sport venue setup when you look at their budget. And revenue varies. You'll see some of these things may not exist in some stadiums, like government subsidies that may not be in existence. Bonds may not be in existence in someone's budget, but some of the other pieces certainly would be. There are some commonalities there, and the same with expenses. So these are just examples. Every budget is different for every venue. We look at income statements. Usually those are on a monthly basis. You want to be able to track your income every month to make sure that you're on track as far as referencing back to your overall budget. Your budget has a bottom line number, and that would be either operating in the black, which is good, positive balance, or operating in the red, which is a negative balance, a deficit. So that is a key. An income looked at monthly will help you to look at your overall number and where you're tracking to get to your goal. And your goal, again, is the bottom line number on your budget of where you're going to end up at the end. So that shows revenue and expenses on your income statement on your monthly basis. It gives you your sales, material costs, labor costs, depreciation, which is always, depreciation is key because that is building depreciates over time. Office furniture depreciates over time. Computers depreciate over time. That is accounted in your budget. And all of your profit margins, profit after taxes, those are pieces that you'll see in your budget as your folks give you income statement to look at. So using your financial analysis to your advantage as you're looking at your income statements and your expense statements, you do want to be able to read it. You want to be able to cross-reference it back to your budget and to be able to see a variance. A variance is simply how off the mark are you from the number you projected. So remembering that a budget is really a projection of where you think your facility is going to be and where it's going to be operating for this year, for the fiscal year. So budgets are done on a yearly basis. And again, it's a picture of where you think you're going to end up. They're not perfect. They're roadmaps, and there are variances to those roadmaps. So you don't want to be totally off the mark, but you want to be as close as you can. And one thing about a budget is that as you look at your variance reports on a monthly basis, you can see where you need to adjust. If you're overspending in a certain category, you can adjust and scale back. If you have excess in a certain category, you can see where you need to adjust there when you develop your budget the next year. So it really is a roadmap, and it is a tool for you to use as you develop your budget year to year. It's also used to sell your product. You want to be able to share with investors and people who would be interested in joining that you do show positive value. You want to be able to share with them that your budget is online financially to investors, and you want to be able to show them that you are able to project pretty close to where you feel that you're going to be, and also gives them a chance to see a return on investment should they choose to invest and sell with you. So once the budget is set up, the numbers are your foundation. Those budget numbers don't move. Once you're in a scenario where your budget is done, let's say your fiscal year starts July 1st, most often budgets are approved by a financial committee or a board of directors. Once those numbers are approved, the numbers don't move. So those are your foundational lines, and that's your projection of where you're trying to get to each month and ultimately year to date at the end of the fiscal year. So July 1st to June 30th, for example, is one way to look at a fiscal year. It doesn't have to be January 1st to December 31st, although some organizations will use that traditional calendar model. A budget also helps with planning. With estimated costs, it gives you an idea of what you're going to need in terms of spending. And then forecasting and reforecasting. There's two different views when we look at budget. We see forecasting as a way to predict ahead and to look at the budget year, and on the planning process, you're actually forecasting how you want that year to look. And that's pretty much the preliminary way a budget is set up. And then reforecasting, if you get through the middle of your budget year and you're seeing you're way off on your numbers, you do want to be able to adjust. Not adjust the budget, again, because the budget is your foundation, but adjust your spending and how much you're going to reforecast when you set up for the next fiscal year. So if you're over in a specific category, you want to be able to log that, and as you set up the next fiscal year, use that information as a tool and reforecast better on the next time you're setting up your budget. And then you do sometimes have different budget sheets for different purposes. For example, there's an operational budget, and then potentially a separate document would be for your capital expenses, capital budget numbers. A lot of times capital expenses, depending on your overall operational budget, would be items, for instance, that would cost over $10,000 to $20,000 that you would set aside for a capital budget improvement or an expense. And it would be off of your traditional budget. And those are things that you would set money aside for that would cover, like a new roof, new flooring, major items that are not necessarily in your operational budgets for year to year. Those would be things that you would do and expense out every 5 to 10 years, and they would be major items.